Welcome back. I'm Leelaa, your host for Invest Wisely, the ultimate gateway to safe and intelligent investing. The low interest rate environment created by the Fed after the market meltdown in the early 2000s led to the housing bubble. Several exotic products were created for people with poor credit or even no credit, people with unsteady jobs or even no jobs. Interest-only loans, 40-year mortgages, payment option ARMs, etc., etc. People presumed that housing prices would be rising forever. Well, the meltdown or the collapse in the housing market occurred, and this led to severe global financial crisis as well. More recently, due to regulation and past mistakes, lenders are now very cautious. But the human mind has very poor memory, especially of pain. When a glowing opportunity arises, newer exotic products may be created, and the novice investor is the one who would fall a prey to this. Foreclosure or short sales may be an excellent opportunity for investors with money, but how could you avoid such problems? The root cause to the problem is choosing the wrong borrowing option in haste to own a home. This is not just for people with lesser resources or money, but also for the well-to-do investors. I see in my practice investors stuck with an investment due to hasty investment decisions. This delays their retirement and also their quality of life as well. Now let us see some common mortgage products to avoid while buying a house. Avoid 40-year fixed loans. It is not always that fixed-rate loans are good and have low foreclosure rates. With a 40-year loan, you tend to borrow for a longer period and hence end up paying more interest for a longer period of time than you actually need to pay. This cuts into your investment for retirement, college or education funding, and several other long and short-term objectives you may have. Next is try and avoid adjustable rate mortgages. Research has shown that borrowers with fixed-rate mortgages have lower foreclosure rate than borrowers with adjustable rates. With adjustable rates, you throw yourself open to interest rate risks. After the initial term, the rate adjusts periodically, and it might be once in a year or 6 months or even a month sometimes, depending upon the product you choose. The monthly payment becomes very high with growing interest rates and at times unaffordable for the homeowner, leading to default. Choose this option only if you know for sure that your income would rise with the rising mortgage payments. Low down payment mortgage loans. You may think it is wise to put a low down payment, but if the house prices drop, you could get caught in this situation because you cannot sell or refinance either. Choose this option only if you have enough cash reserves elsewhere to buy yourself out of your mortgage in times of crisis. Interest-only mortgages is yet another product you must look at with caution. Here you tend to pay a much higher interest on your loan than a conventional fixed-rate mortgage. Here, as a borrower, you pay only the interest for the first 5 to 10 years, and this gives lower monthly payment, which is the main attraction. This option must only be chosen by people who have potential for increase in their income in the future and are disciplined enough to make higher payments when they can afford it. Finally, let us look at the interest-only ARMs. This is for people who can withstand and tolerate the swings in the interest rates. The interest rate is not fixed here and can move up and down with the market. In rising interest rate environment, using this option to buy your home can sometimes lead to dangerous results. People will need to have the emotional frame of mind to withstand the insecurity that comes with this type of loans. It is best suited for wealthy investors who have the opportunity to use the extra cash and earn a better return elsewhere. This is not for the lesser affluent who will fall a prey to the market movements and lose the roof over their head. Foreclosures also occur due to default on your property taxes. So be up to date not just in your mortgage payments, but also in your property taxes. Coming up next is question time. Stay tuned. Invest Wisely will be right back after the break. Welcome back. I'm Leelaa Rao, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. I have here a question from Dr. Sompalli in Florida. He says, when buying foreclosure or short sale properties, what should one look for in order to avoid making a wrong investment choice? Very good question, Dr. Sompalli. As I mentioned earlier today, these properties are sold as is, and you need to do a careful inspection to avoid a lot of future costs that may sometimes be never-ending. Also make sure you check for any further liens on the property you are interested in. Apart from this, you need to make sure that the property in question is in well-established neighborhood. Talking about neighborhood, make sure you choose a clean subdivision. It does not mean that you must look for newer neighborhoods, but well-maintained ones. Look for properties that have major facilities close by. Some subdivisions are very well designed, but are in forlorn places. Make sure that shopping, hospitals, and good schools are close by. This will also provide a good resale value for the property. A lot of people think that buying a dilapidated property, fixing it up, and reselling it would fetch a lot of money. It is easier said than done because it requires your valuable time, and if you are not good in doing the job yourself, you need to find good laborers or contractors at the right price. A good rule of thumb is that the fix-up cost must not be more than 5 to 10% of the purchase price. Well, doctor, after all this, look for a realtor whose eyes are not just on the commission, but would give you honest advice. We welcome you to write to InvestWisely at tvasiausa.com with your questions and comments. Alternately, visit the following address shown on the screen to be directed to your question form. You may also write to me at leelaarao@goodwinasset.com. I'm Leelaa Rao signing off for today. Until we meet again, remember, do not feel rich earning money, but invest wisely to be truly wealthy. Thank you.